That's right. And the world's run by experts, and our job is to undermine that. So
that's going to be the opening clip of your video right there. I'm going to splice that in.
Yeah, it's true. I mean, look, the experts fetish is a European thing that came in the 20s. I mean, before that, Americans were practical people. They didn't have much time for theory and professors. And I was reading a book by pre-World War II right people, John Flynn. And he makes the point the professors were really, really unhappy because they make less than the milkman delivery man. And I was like, they do? Like, wait, what year was this? He's writing in the 40s, and it's like the idea that a modest businessman can make more than a professor today in our world is like totally insane, right?
Well, they fixed that problem.
Right. Well, that's right. I mean, who runs the world? Professors do. Of course, there's a revolving door between professorships and the government, so that's how it works. But
Dan Oliver, founder of Myrmikan Capital, is joining us today on Wall Street Silver. Dan, how are you, sir?
Great to be here. Thanks for having me.
Awesome. Thank you for taking your time for joining us, Dan. You're known for having a pretty aggressive target for the price of gold, and we want to get your thinking on how you get to that target.
I mean, the first thing to do is realize that gold is money, right? As J.P. Morgan said, and nothing else. And so it's not that it is. You have to think about how high gold is going to go in a vacuum in dollar terms, and looking the world through the dollar lens. It's gold is the stable thing, and people push back on that. What I point to is that if you look at commodity prices, it's not just they're more stable in gold terms over time; they're less volatile. So, for example, if you price oil, which is the most essential commodity in the industrial age, in gold terms since 1971, when the U.S. left the gold standard officially. It's not just that the oil prices are more or less the same price in gold terms as they were back then, as opposed to dollar prices, which obviously much, much higher. But the rolling 12-month volatility is 40% in gold terms and 60% in dollar terms. In other words, so looking at the commodity lens through the gold, commodity prices through the gold lens makes the world make sense. And there's a reason for this. This is a long answer to your question, but I think it's important for the background. And that is that gold comes out of the ground. I mean, you have to expend commodities, oil, steel, rubber, labor, all the things to mine gold. And so when there's a scarcity of gold and the price goes up, marginal mines go into production and create more of it. And then when there's a surplus of gold or surplus of money and people don't want more money, then gold gets cheaper and the marginal mine shuts. It also, expensive gold gets people to melt their jewelry down and melt it back into monetary form. And same thing, cheap gold gets people to go buy lots of jewelry. So there's two forces in the real world that keeps gold stable in terms of commodities, or rather I should say commodities stable in terms of gold. And every consumer product starts as commodities. And so if you stabilize price in terms of commodities, you're also going to stabilize at some level consumer prices. And the reason I think it warrants an explanation is because Bitcoin, for example, which is a lot of young people think Bitcoin's the new gold. It has no relation to the real world. There's nothing that modifies its quantity to meet the demands of the market. The demand for money is not a constant; it goes up and down, and gold can respond to that. So that's a long-winded, actually short. Yes. I've got a 1,000-page book I can send you, but short and long-winded, same time explanation why gold makes for good money. In addition to all the reasons we know, it doesn't oxidize, longevity, all those other things. And so once you realize gold is money, you're really asking, what is the dollar's value in terms of gold, not vice versa? And again, as anyone who's studied any monetary history knows, that all currencies begin as just an expression of the precious metals. So the dollar was defined originally as a certain weight of silver, and then of silver and gold, and finally gold. But it's the definition of it. It's not backed by it. It's the definition of it. And then the next step is that those two things get distinct, right? The idea of dollar was being backed by gold, having an independent value away from gold that the Fed can manipulate. And then now to where we are today, where basically the dollar is a fiat currency that floats on the whims of the market, supply and demand, and Federal Reserve policy. So the way I look at gold in dollar terms is really through the dollar. And what is a dollar? Again, today, the dollar is a unit of liability of the Federal Reserve. They create them through bank reserves and send checks to people for not working, and they can theoretically destroy them. Now they use that power very seldomly and very short term usually, because bad things happen when you start taking fiat dollars out of a credit system. But that's what it is. So if you think about that framework, and you think again, how did the Federal Reserve get going? Well, its first balance sheet showed gold roughly 80% of its assets. So its liabilities were backed by about 80% by gold. And the rest was short-term government bonds and other cash items and strange things like that. And then the history of the Fed is that 80% number just gets lower and lower and lower. So it got to about 50% to the 20s. That was that bubble. And then in the 30s, when the Fed raised the price of gold to $35 an ounce, or I should say lower the value of the dollar, the Fed's balance sheet got up to 84% of its assets. And so basically, by the late 40s, a dollar in your wallet was 84% backed by gold. Well, that's not bad. I mean, people are going to transact on that basis. And that's when the Keynesians took over. And again, this is all my writing to try to condense this, but the Keynesians printed, the conceit was that they could manage the business cycle, they could manage the price level by having the Federal Reserve, the central banks, buy government bonds. And by 1969, they bought so many government bonds, and we'd lost so much gold to Europe. It was illegal, it was a felony for Americans to have gold, but European governments could still redeem their dollars for gold, which they did. And so by the time we get to 1969, the peak of that bubble, the Nifty 50 and that whole thing, the Fed was backed by 12% gold. And then the way I view the 70s, and again, this is very idiosyncratic, which is why, it's different, but I think it's accurate. It wasn't that the Fed Reserve printed so much money in the 70s. They did. But the real story was that gold went from being 12% backed to 100% backed. And the way I look at it is pre-1930 central banks, when the central banks were committed to redeeming their currency into gold, you could show up at a central bank in Europe or the United States with paper money and say, at the central bank, all right, give me my gold. I'm nervous about your currency. And there were runs in central bank in Central Europe. You can't do it today. You haven't been able to do that since the 30s. But you can still go to the coin store and you can say, look, I've got these dollars. Well, I don't want the dollars. I want the gold. Mm-hmm. You buy at the coin store. And so the way the market stages a run on the central banks is by setting gold at a price that backs its liabilities. And what happened was in the 70s was by 1980, the market had lost such confidence in the Federal Reserve under Arthur Burns and Carter and Nixon and Ford, to be fair, that at $6.50 an ounce, and gold hit $8.75. At $6.50 an ounce, when it hit that number, the Federal Reserve liabilities were 100% backed by gold. And so the dollar in your wallet was 100% backed. So we were basically, the market had returned us to a gold standard. And no one else thinks of it that way. Economists don't, politicians don't. I've never heard anyone else express it that way. But that is, in fact, that's just math. I mean, that's just what happened. And then the monetarists took over, and they're just Keynesians by a different name, essentially. And that metric has now gone from 100%, over 100% in 1980. And by the way, that was not a good time to be buying gold. Once your currency is backed by gold, it's probably a good time to buy productive assets. That ratio is now down to about 6 or 7%. And so my whole thesis is that there is going to come a time when the central banks of the world and the Fed lose control of interest rates, lose control of the bubble they've created. And the way the market will stage a run on these institutions is by setting gold to a price that makes their balance sheets balanced. Now, it doesn't need to be 100%. That was excessive. But it does need to be, 30% was the average in the 19th century. That was normal times. And these are not normal times. So I could see 50%. I could see 2/3. I could see 100%. It happened before. It could happen again. And the Fed's current balance sheet, those numbers are well above $20,000 an ounce. That may sound crazy to some of your viewers, but just consider that in 1969, gold was $35 an ounce. And by 1980, it was $8.75. So it went up about 33 times in value in that time period. And the other thing to keep in mind as an investor is it was not a smooth move from 35 to 8.75. There were two periods in the 70s, two about 24-month periods when most of the gains were experienced. And so when panics happen, they tend to be self-reinforcing phenomena. So you can't really wait in the market and say, well, I'll get on when I see the real panic happening. It's far too late by then. You've got to be already in the market.
You've talked about 10,000 gold in the past, and you just mentioned 20,000 gold.
Yeah.
And
I think I'm like that TV guy, right? I had 30,000. But again, go back to the math is the only point. It's just math.
Well, I was born in 71. And so I didn't know the history before that, just the history I've read. And I recall numbers like the gold standard was 40%, so to speak, at that time, or that was the intended target to have gold backing the dollar by about 40% of the assets. I don't know if that was statutory or just traditional. I'm not sure. But how does this cycle that we're experiencing right now different from previous gold cycles? Because I know history is supposed to rhyme and all that stuff, but it seems like this one's a bit different in that the Fed is trapped. They can't raise interest rates. They're sort of stuck in this, if we raise interest rates, we blow up the economy. If we don't raise interest rates, the inflation runs out of control. And there's no real solution there. And I don't think that element has existed in previous gold cycles.
Well, let me back up quickly to your question about whether it was statutory or tradition. The answer is both. In the 19th century, when you could show up at the Bank of England and say, "I want my gold," right? It was market driven. You could deposit your gold, get money, or vice versa. And the number that the market wound up with in the 19th century over time in both private banks and the Bank of England was about a third. It was about a third. But keep in mind, again, the other 2/3 were very short-term government bonds and also commercial invoices. So very, very solid, very, very short-term, very, very non-interest rate sensitive assets. In the Federal Reserve's case, the ratio, the coverage ratio was set by statute, which kept being changed lower as the policymakers changed them. But to your, I think, more interesting question about how this is different. I mean, certainly it's different than the gold standard period in the 20s and 30s, because at that point, the Fed, again, before they changed the rules in 33, had to have a certain amount of gold coverage. So when the market crashed in 29, contrary to the monetary myth, the Fed did aggressively go into the market and start buying treasury bonds immediately and lowered interest rates very low. But they had to stop because they hit the limit of their powers to do that under the gold standard. And also, given the traditions at the time, they certainly weren't willing to do what Bernanke did, for example, in 2008. And so they couldn't escape from the deflationary pressures. In the 70s, I'm sure Arthur Burns gave a speech about, he was the chairman of the Fed during most of the 70s. He gave a speech called the Agony of Central Banking, some title like that. And he says exactly what you're talking about. He said the Fed had the authority anytime to raise rates and rein in the inflation, but he didn't think that a federal agency should have the power to undermine the congressional policymakers' power to spend money. And that's actually what Mackenzie Martin said in the 60s under Johnson, too. In other words, the Fed was a part of the government, and it couldn't undermine what the Treasury and the Congress were doing. So they were fully aware they could do that, and they didn't. And what Volcker did was exactly what you're talking about. He raised rates up to 21%. And what did we get? The biggest economic slowdown since the Depression. Now, the difference between then and now is that then the 70s inflation eaten away at the debt to GDP levels. And so the country could withstand that kind of shock treatment. It was unpleasant. I mean, the first 2 years of Reagan's term were pretty rocky. And Congress wanted to impeach Volcker, and Reagan probably got blown out in the election, the midterm elections of Reagan's first term because of the shock therapy. But again, the debt levels were low enough that they could get away with it with some unpleasantness. And the difference now is, first of all, the Fed has unlimited powers. I mean, look at 2008. No one thought that was possible, except, of course, the policymakers. Japan had been doing it, and Bernanke had been running around giving speeches about how, long before the panic happened, about how the U.S. should be in a position to do the same thing. So he was fully prepared from a academic perspective to do that once the panic came. And so they did do that. And again, that kind of activity by the central bank was unimaginable in a previous generation, even if they had the power to do it. And look, as I often say, because I got run over in the early 2000s. I got in the gold trade in 2008. That was what got me into the trade, was that event, and forced me to re-examine my assumptions, forced me to start reading history, because, of course, I went to all the fancy schools. They don't teach you any of this stuff. They teach you Keynesian nonsense, propaganda, I should call it. But it worked. Bernanke's policies got the government back on its feet, got the housing market back on its feet. It got it's the stock market back on its feet. So I mean, it was successful in those terms. Now we know from an Austrian perspective, it just made the imbalances worse, and the ensuing crash will be that much worse. But again, from a short-term policy perspective, it was in fact successful, and that's why gold did so badly in the beginning of 2000s. But again, long-winded answer to your question. Now we've reached a point where the debt is much, much higher than it was in 2008. And so the policymakers, as you rightly say, are completely stuck. If they keep rates where they are, we're going to have, I mean, not just inflation, but continuing inflation. It's already here, and it'll keep getting worse. And if they raise it, the whole world will unravel. And what's interesting is Powell, in one of his Q&A sessions, not the most recent one, the one before that, the Bloomberg correspondent asked him that very question. And I was shocked because usually the corporatist media, run cover for the Fed and the federal governments and all the apparatchiks. And they actually asked Powell that question. And Powell's answer was, well, look, there was no inflation in 2008, so it won't be any this time, which of course is already incorrect. And we can go into why that's incorrect. But he also said, look, the taper we did, it was a strength of balance sheet, and whatever it was, 2018, shows we can do it. It's like, yeah, I mean, well, yeah, I mean, you can do it for like 8 months, 12 months. And what happened? I mean, people forget that in September of 2019, the repo market blew up, and the Fed was already printing money before the virus shot up from China. It was already unraveling, and that just gave them an excuse to juice it. But so, yeah, I mean, sure, they can shrink the balance sheet for a number of months. But then the wheels start popping out again. And again, the forces at work here are much, much more powerful than they were in 29, in 1980, in 2008 even. And so, yeah, they are stuck. They are really stuck.
No, I have a question about, broader assets.
Sure.
I believe commercial real estate is in a bit of a bubble right now. They're not getting back the retail that they used to have. They're probably not going to be getting the rent for commercial office space in big cities, like New York. Do you see that as a problem in the near term, where we're going to see like collapse in prices and we're going to see asset deflation of things that are credit driven? And if so, how is gold and silver going to respond to such a scenario?
Yeah, so I'm not an expert in the commercial real estate market, so I don't want to give you a specific opinion about that. But I'll just say in general, one of the effects of the financialization of a country is that all the wealth concentrates in the cities. And again, it's happened certainly in our time. I mean, all the wealth is in New York and everywhere else has been impoverished. But you can go back, you can look at France 100 years ago, 200 years ago. Same thing happened. All the money went to Paris. In London, all the money is in London. And so what happens is, of course, is that urban real estate in the money centers, not Detroit, obviously, right? But in the money centers where the money is printed, the real estate prices and the office prices go up tremendously. I mean, the first big bubble, modern bubble, was the Mississippi bubble in France, and the street where they traded the securities on. I mean, people. There was a hunchback who rented his back out as a writing table to record contracts on. He made a lot of money doing that. All the houses, were enormously rich. So the money attracts concentration. So it goes to logical that when the bubble finally unravels, that real estate value will also lose its support. So yes, I mean, of course, the stuff's overvalued. But what's different? What I'm interested in might be different than past cycles. Is unlike in the past, you no longer need to be in the money center, and this is very recent, right? All the hedge funds moved to Florida, low tax jurisdictions, and with the internet and trading the way it is, you really don't need to be in New York anymore. And this has tremendous implications for New York. I mean, what you need is about 3 economists to go meet with the New York Fed every now and then to get to front run your clients, and that's all. Everyone else can be somewhere else. So it may be that New York commercial real estate has problems long before the bubble finally unravels. But the implications of gold are, again, the policymakers who run the world, the Fed, but behind the Fed are what? The banks, Goldman Sachs and Morgan Stanley, all those people. I mean, they all derive their wealth and power and influence from this system. And so they will do whatever they can, whatever they have to avoid the system blowing up. And so when it blows up next time, they will print the money. They will keep printing the money until the whole thing falls apart. I mean, I think that's become clear. I mean, it always was theoretically likely, but it's become clear that that's what they're going to do.
Do you have any time frame for your targets? Any waypoints along the way that you're looking for?
It's a hard thing to answer because I know it's a tired analogy, but it's snowing hard. You don't know which place can cause the avalanche, but what you do know is maybe it's not a good idea to go skiing today. What usually creates a bubble to collapse is, in my view, not loss of confidence. I mean, that's what, once it starts, that's what keeps it going and accelerates it. But what normally ends a bubble is overcapacity, right? And think of the housing bubble, right? The Fed underwrote the banks, and the banks lent money to everyone and their dog to go buy houses, and it pushes housing prices up. And in a free market, which we don't live in, but we sort of think we do, once you get overcapacity housing, rents start falling down, and then landlords can't make their payments, and people who bought houses plan to flip them, all of a sudden they're caught with their pants down, and the banks blow up. So that's what usually happens in a bubble, like an overcapacity ends it, and then once you start getting cascading defaults, right? I borrowed a lot of money, I defaulted the bank, they defaulted, nice guy, the whole thing unravels, and again, what part of Fed policy is, and this is clear if you read the transcripts of their meetings, is that they know this. And so they know that they can't allow cascading failures to happen. So once they see failures of a certain magnitude happening in any part of the economy, they step in to stop it because they know what happens, like 2008 happens. And so again, as I say, all these guys are all complicit in this bubble, and they make their money from it. So that's why they keep stepping in and putting the money. And it's hard to imagine what would get them to stop.
What you were alluding to, in that because of things like Zoom, we no longer need to all concentrate in money centers. We see that right now. I live in Florida, and all the houses around us, they're gone in a day. It's just so obvious from at a very basic level right now that, for a variety of reasons, Florida, Texas are not just a destination to flee for taxes, but also at this point in time, virus restriction freedom seems to be a primary issue. I can't tell you the number of Canadians down here in Florida who come for the winter and they're not going back. Normally they leave in March. They're still here. Yeah. And it's causing all sorts of chaos in the rental markets and the Airbnb market down here in terms of the Canadians won't go home, Ivan.
Yeah, they don't want to come. I'm in Canada right now. You can't do nothing. You can't get a haircut. It's brutal.
Well, I mean, I think the fault line in U.S. culture right now isn't red-blue states, because you go down to the county level. We live in a red country with some splotches of blue here and there where the cities are, and I think it's not sustainable to have two ideologies and ways of living that are so opposed to each other. I think that is a fault line that will grow over time.
I think there's a lot of frustration on both ends for that.
Yeah, but of course, I mean, the blue people, the cities think that they're the rich, sophisticated people because, again, the Fed prints the money into the cities and they control the money, and so they're like New York's GDP. I forget, it's some crazy 8% of the countries or something like that, right? Wow. What does New York actually produce? I mean, it started as a trading hub. That's great. It was a manufacturing location. Okay, that makes sense. That produces well. Okay, then okay, the factories left. At least the guys running the companies were there. I see that being productive. Okay, they're gone. I mean, it's nothing. It's finance people hitting buttons, and then degenerate culture that comes out of those cities. So I don't think that they're very productive, but they consume everything, right? And people send all their food, all their goods into these cities to be consumed, and they do it because people pay for it with funny money, and at some point when that money fails. I think the whole economic model of the cities also fails at that point. And there's a big shifts in societal organization.
You must have some insight into FedCoin and the whole Great Reset they're talking about. And do you have any time frames for that or thoughts? And how do you think precious metals will be in that environment?
Yeah, so if you go back and read, I think it's in Capitalism, the Highest Form of Imperialism by Vladimir Lenin. One of the things he talks about is how a socialist economy would be impossible without the big banks, because the big banks allow a government to see what's happening in the economy. And he envisioned a big bank that would record every transaction in the economy. Now, of course, that was impossible in 1917, but that is, in fact, precisely what the Fed wants to do with FedCoin. I mean, they're living through Vladimir Lenin's vision, and that should give you pause on what this is all really about. I think the banks are investing tons of money in crypto, not because they believe in Bitcoin or anything it stands for. I mean, I think Bitcoin won't work, but I appreciate the ideological movement behind it. It's because what they see is that if Bitcoin is successful, they'll be disaggregated from the payment system and from the potentially credit system. Whereas if they implement FedCoin, the papers I've read coming into Yale, for example, the idea was the Fed would issue these things and the banks would manage them. And so instead of paying a fee every time you go to an ATM machine, you would literally pay a fee every time you bought something. I mean, it would be small, but every transaction would lead to the bank. So the banks, on one hand, have the threat of disaggregation. On the other hand, they have the opportunity of putting their tentacles into literally every transaction, which should also give the Fed an insight into every single transaction. And of course, in that environment, if you use cash, you are by definition a terrorist. Right? That's what right now Rogoff calls $100 bills terrorist instruments, but it'll be $1 bills once this system goes into place. So again, it's tough because it's the kind of proposal that is really tough to do in a normal environment. But when you get a bigger crisis, as Rahm Emanuel said, a crisis is a terrible thing to waste, right? I mean, there's some crisis of the currency or something happens, and you just roll that model out. And look at the success of all this virus nonsense. People just got in line and followed the rules. I mean, it's extraordinary. And so it's now again, they thought their lives were at stake, and I mean, a fraction of them potentially were. Most people were not in any danger of this thing. So I don't know. It's scary. It's very scary.
Remember when TARP, the original TARP bill back in 2008, late 2008, everyone was in a panic because of Lehman Brothers and everything was just collapsing. And the first time they voted on TARP, the asset purchasing bill, it failed in Congress. Yeah. And they told them that, the powers that be at the Treasury said, no, wrong vote, go vote again. And until you get the right answer. And that's right. No one reads these things. The legislation for all this was written way in advance.
That's
they're
right.
They're just waiting for the crisis. They're waiting for the panic. When no one's going to have time to read it. They're going to tuck it right in. And that's when we're going to get that federal FedCoin, whatever, reset system.
Yeah.
And that's when it's going to happen. And
I agree.
if they don't get the panic on their schedule, they will create the panic. They will some false flag operation. I don't know. I need to have my tinfoil cap on my head.
But you almost don't need that, right? I mean, think about socialized medicine. I mean, this was a social idea that came out around in the 1910s, so as part of the Communist Revolution. And they advocated for this for decades, and they went nowhere. And then all of a sudden, the 60s happened, and once they got it told, it's increased constantly, relentlessly ever since. And because part of the communist thing is once you socialize medicine, you can socialize everything else, right? Which again is what's happening. And so they've got the long game here. I mean, I don't think they need a panic. They create a panic next year because they come often enough. And in their view, history is on their side. And so they are in a hurry, but on the other hand, it's been a very successful strategy. I mean, you got to hand it to them. It's been an amazing journey for the lefties.
Socialized money, and we've had socialized medicine, and as a result, I think we've had inflation. Would you agree with that?
Well, yeah. I mean, of course. I mean, I read a study. Apparently, in England in the 60s and 70s, there was a two-tier inflation rate. Basically, things that were socialized went up, at 100% doubled during that time frame. Things that weren't went up at 20-30%. So the market adapts and makes prices lower. That's the function of the market, right? Is to reduce scarcity and make things cheaper. And that's what it does. And it's the function of government to not do that. And bureaucrats are not in a hurry because they get paid by the hour, or they just get paid whether they show up or not. And so of course.
During you're obviously a great student of economic history. I've been floored listening to your interviews and just listening to you today, the knowledge that you can just pull off the top of your head. And what I want to ask you now is about during the Weimar Republic, during that hyperinflation era.
Yeah.
Obviously gold went up, but it didn't go up in a smooth line. It was a very chaotic process. And I've heard you talk about this before in interviews, and I'd love for you to share your explanation of that period of time with our audience.
Yeah, sure. So the most recent letter I did actually talks about how when you look at hyperinflating currencies, the quantity of currency goes up on a parabolic curve on a logarithmic scale. So, which is just an incredibly powerful thing. And I have a chart in my materials that shows by my marks with that parabola on a logarithmic scale, the normal thing in hyperinflation, but also the month-to-month change in the gold price. And it gets more and more, that line, that monthly change in the gold price gets bigger and bigger as the volatility of it gets more and more as they get further into the hyperinflation. And what the chart doesn't show, but what's important to understand is that nominal interest rates, of course, didn't stay at 2 or 3% that we are now. I mean, nominal interest rates were 100%, 200%, which were low, right? I mean, when inflation is running at 400% and you can borrow at 100%, you do it all day long. But everyone saw what was happening, right? I mean, so this is so easy. I mean, if gold or other assets going up this fast, I'll lever up as much as I possibly can and buy as much stuff as I can, and then the debt will melt away. And as everyone does it, of course, everyone's exposed to reactions. So price goes the wrong way, and all of a sudden you get a margin call, and now you got to sell your asset, and that pushes it down to trip for the next guy. And so the volatility keeps increasing because people get too clever about that, which is why one of my things, I operate in the junior gold mining space. I use margin. I mean, they're levered enough as it is in terms of operations. Financial leverage on top of that. It's like, what's fantastic debt, a great way to short the dollar is you take a 30-year mortgage on your house at 3%, right? They can't call that. It's not like the house goes down in value and they call you up and say, give us the rest of the money, right? So you can ride out that volatility, whereas you do that in the stock market, your E-Trade account, you have a margin loan, and it goes upside down on you. I mean, you're wiped out. And there was that business with the Swiss franc, remember that? Where currencies don't move very much, so everyone's levered up, and over a weekend they had a policy change, and the Swiss franc crashed like 10%, some number like that. So you not only lost your money, but you got a bill from E-Trade for $200,000, and of course they closed your position out, and then the currency bounced back to a normal range. But so what? You owe the money, so you got to be really careful when things are too easy. Just to think about what can go wrong and manage the volatility as you get deeper into the cycles. The first chain stores in this country got going in the 20s for the exact same reason. You could finance at much lower rates if you were a business, much lower than the independent businessman. And so it made sense for you to go buy up a whole bunch of real estate and create your chain store. And basically what you're doing is, when you do that, is you're converting little bourgeois, to use the communist term, but it's a real term, bourgeois businessmen into employees is effectively what you're doing. And once you do that, employees just don't care that much about the business. They care a little bit, but not like a little owner. And then when the 30s came, all those chain stores blew up and went away. And so that, again, another function of inflation is to concentrate economic power and wealth in ever smaller and smaller hands. And that's what's happening. Little businesses are all closing with the help of the whole virus scare, but just naturally it happens. And one of the things I talk about is, you look at the Federal Reserve data. The larger the loan size is, the lower the interest rate is. So the bigger company you have, right, the lower your cost of capital is. And so it's just math. These guys hire these people at MIT or whatever it is. And then you say, well, look, if I buy a different company, immediately I get a gain because I can replace their cost of capital with mine. And so you look at any sector of the economy since 1980 to today, which you'll find is massive industry concentration. And that's what drives it. But there's a cost to this. And it's something I learned, believe it or not, in law school that I've always carried with me, and that is that there's a trade-off between flexibility and efficiency. So the example that the professor gave at Columbia was if you build a cigarette machine with huge throughput, it can cost $10 million, and the cigarette machine can spit these things out in every tenth of a nanosecond. You want to make the cigarette a little bigger, you need a whole new machine. That doesn't work that way. Whereas a hammer, is pretty cheap. You can do a lot with it, but it's just a different animal. And so when you get a big company, it takes a lot of debt on to buy their companies and become big the way you get it in college consolidation. They get all this debt. Well, you can't use debt to innovate because you never know when the cash flows from innovations are going to show up to make the debt payments that you owe, right? You can only use to become more efficient. And so what you get is hyper pursuit of efficiency. And Adam Smith wrote this, but what efficiency does is you take everyone's job and you try to simplify it, right? So Amazon, there's a guy who takes something out of one box and put it in a different box. It's a really simple operation. And that operation doesn't get paid that well. The wages for that is pretty low because it's pretty unskilled. And meanwhile, the guy who owns Amazon, Bezos, gets super duper rich, right? And so, but it becomes very, very efficient, but totally unflexible. I mean, if every restaurant became McDonald's, right, the cost of doing that would go down. But of course, the food's not very good. So and so one of the things again that's happened in our economy is we see more and more efficiency, which does lower prices, but it also lowers the quality and diversity of the products you can buy. And think about your phone. Think about you call the bank to talk to someone, you can't get anyone. I mean, it's everywhere you look, and it makes being a consumer a real nightmare.
Corporations have gone to just-in-time inventory for the past few decades, and we're starting to see some real constraints in the supply chain.
Yeah.
How do you think that ties into inflation and what we're
it's a great point. So Carl Menger, who is the father of the Austrian economics, wrote about how the European mills all bought cotton from the south of this country because it was the cheapest, most efficient way to do it. In the Civil War, all the mills stopped because they couldn't get cotton out. And they learned then that you're better off having 3 suppliers, even if they're not as cheap, right? Because you want flexibility. So if one doesn't pan out, you can use the other ones. That's if you're an owner, right? You're an owner, you own the business, you don't want it to fail, you want to pass on your children. Okay. What if you're a manager and they've given you stock options? And if the stock goes flat or down, you get nothing. You get your salary, but you don't get any extraordinary wealth. If it goes up, you become really rich, hundreds of millions of dollars. Are you really going to design your supply chain to be robust and resilient, or are you going to say, look, let's just drive costs lower today so that I can cash out my stock options tomorrow? So part of the managerial revolution, which again occurred in the 60s and 70s because of inflation, made corporate America incredibly brittle. And that's what we're seeing now, where again, these supply chain issues are just ballooning everywhere because of just-in-time inventory systems, which a free market would never do. It's only because of the credit that the managers can corral to make these huge bets, which if they pay off, the manager gets hyper rich. And if they don't pay off, well, the shareholders are left holding the bag.
You've spoken in the past about we're headed towards a real crisis, and you've even referred to it as a fourth revolution.
Yeah. And
I'd like for you to explain that concept to our audience. Where you're going with that?
Back to a letter I wrote a while ago. So the first American Revolution, of course, was in 1776. It was not actually about slavery, as the New York Times would tell you. It wasn't really even about freedom. We were loyalists, my family. So it was about smuggling and rum. But smuggling is a free market in its own way. So I'm at this point, in history, I'm pro the revolution, although it's hard to say that, given that all our houses and lands were confiscated. But really, it was reflected, or it began to reflect Enlightenment ideas about individual rights and individual freedoms, which is why, how much do public schools focus on the colonial period of this country? And they're really none, right?
Now.
Yeah, 0. And maybe they see a picture of George Washington, that's it. The second revolution was, of course, the Civil War. And that was really a revolution. I mean, it wasn't a civil war. A civil war is 2 factions fighting over power to the whole country. And this was a war of secession, and someone called it. And they're right, they were trying to secede, and they didn't. But the effect of that was centralized government control, right? If you read all the court cases and politicians before the Civil War, it was universally agreed that the Constitution did not give the power to create currency to the federal government. It says right there, gold and silver has to be currency. And the greenbacks were created during the Civil War to fund the army to fight that war. And so that centralized economic power. Of course, political power is centralized. States' rights went out the window, so that's centralized political power. So it really was a war about the centralization of power. And it was after the Civil War, the railroads, which were heavy users of debt, which was great because there was a fiat currency for a period of time, we're 35 times larger than the largest pre-existing corporations. So you don't have large corporations before the Civil War. You have them afterwards, because that's when you could borrow money at essentially negative interest rates. And of course, again, as part of the Austrian thesis, what do you get? Huge booms and busts in the railroads, because lots of investment, overcapacity, and then collapse. So that was the second one. The third one I would say was in the 60s, which was a revolution about destroying what I would call traditional American identity. So power was centralized in the state, but culturally, we still represented a colonial government, can-do people, individual responsibility, all those things, and that went away in the 60s. Right, the government's here to help you. We'll manage the thing directly. Your lives are directly, not just through institutions like the banks. We're going to manage your life. And then the one we have now is really one for Western civilization. I mean, it's a Marxist, Black Lives Matter is a Marxist organization. It's anti-family, it's anti-capitalism. And what I mean by capitalism isn't, we don't live in a capitalist economy anyway, but what I mean is that they don't want you even to have individual wealth, right? They want redistributive taxes. They don't care if raising the capital gains tax actually reduces revenue. They don't care about that. They want to take the money away from you and transfer it to people who they like. And what it really is the reemergence of tribalism. So if you think about Europe pre-Roman, it was lots and lots of tribes who all hate each other. And the Romans showed up and conquered them militarily. And then the church kept them together for the next 2,000 years culturally. And what we see in the demise of the EU is all those tribes everyone's forgotten about, because they've been melted so long, falling apart, right? Scotland wants to leave England, and there's Scottish tribes within that all hate each other. I mean, Italy is falling apart, right? So it's going back to a post-Christian tribal conflict, and that's essentially what is happening in the United States, where identity politics, it's basically tribal politics. Who looks like you, who thinks like you, and will compete for the spoils that the system arrives, and there's no sense of individual responsibility and individual working together to create wealth for everybody. And that idea has basically been abolished. And that's the struggle we're in now. And unfortunately, those forces are certainly in the ascendancy. And I hope something happens to change that, but that's what's happening.
We had a guest recently whose name is Stephen Van Meter, and he was trying to argue that what's currently going on between the Fed and the banking system, where they're just creating bank reserves. He's arguing that's deflationary. It's not inflationary, that these bank reserves do not leave the system, can't. And I guess a lot of us who were investing in precious metals, gold and silver, we sort of disagree with that. We think a lot of that leaks out of the banking system in the form of inflation, or the central government making direct payments to people through these stimulus checks or whatever. I think you're the right guy to ask this. Is this deflationary or is this inflationary, what the Fed's doing? So
I alluded to that earlier in the interview, the difference between 2008 and now. And the difference is this. In 2008, the Fed Reserve, quote unquote, printed money, and they said they weren't doing that. They were just creating reserves at banks. And that was true. Right? They gave reserves to banks. And remember, what banks do is they lend money mostly against assets, not exclusively against assets. There are consumer loans, but most loans are to buy houses and build factories and buy airplanes, that kind of thing. And again, as we talked about earlier, what that does is it artificially increases prices of those assets and therefore construction of new assets. And that's deflationary, because when you get overcapacity in an asset class, the thing that thing produces goes down in price. You get too many airplanes, airline tickets go down. You get too many houses, housing prices go down, right? So what it does is, at first, it juices commodity prices, because you need to build all those things, right? And wages in those industries go up, because everyone's busy constructing buildings in New York City or whatever it is. Then the after effect is lower prices in those interest rate sensitive parts of the economy, right? And so that it's sort of half true, half untrue. What happened in most recent episode is they also financed the sending of checks to people to consume immediately. So the government says, you're not allowed to work, but we're not, as politicians, we're not going to create a situation where you can't consume what you were consuming before. So we'll print the money up to send you a check, your checking account, which you can use to buy food and pay your rent. That's just inflation. That's just consumer inflation. And so the difference really is between consumer inflation and credit inflation, right? Credit inflation juices asset prices, commodity prices, and a debasement, which I call is the difference. It juices prices of your living costs, oil, food, that kind of thing. And so now we're seeing both. I mean, part of the current stimulus also goes to the banks, so they can also keep buying securities and building assets that no one really wants. So we're seeing both right now, but they can't get the consumer inflation back in the bottle, right? I mean, the asset inflation will crash at some point, but food prices are going down. When General Foods increases the price of Cheerios, they don't undo that 6 months later. That is a permanent increase in prices, and that's what's happening all around the world, right? The prices of basic staples are going up because of this debasement, and that's going to continue.
Do you keep precious metals yourself?
Yeah.
Or do you just invest?
Not on me.
You don't have silver coins right there on the desk in front of you? Why are we talking to this guy? Come on.
Not on my person. You don't know where I live, do you? So silver is interesting. And how much time do we have?
Oh, as much time as you want. I mean,
I'm sure you guys know. I mean, gold really is money. I mean, I said that earlier. It's not true. Gold is liquidity, and again, this comes straight out of Colin Menger, right? It's meant to make barter more efficient. And in a specialized world, barter doesn't work. You got to have some medium exchange to make it work. And the original medium exchange was cows in ancient Greece, or grain in Mesopotamia. I mean, things that were consumable but also very liquid. Liquid meaning you could identify it, you could measure it, you knew the quality, it was long lasting, all you could transport it easily, all those sorts of things. Once mining got going, copper became the natural monetary medium because it had better monetary elements than grain or cows did, then silver, then gold. But silver wore the monetary crown for thousands of years until there was enough gold to make the shift. I mean, as Xenophon, writing in the 4th century AD, noticed that silver prices were more stable than gold prices were because gold was so scarce. There wasn't enough that had been mined by that point in history to make gold good money. So silver was money, and the Bible talks about silver as money, not gold. But as gold crept in the economy over hundreds and thousands of years of mining, gold has better monetary characteristics than silver does. And for about 2,000 years, there was a bimetallic system whereby, because of gold's high value, you'd only use it for capital transactions, to buy a ship, to ransom your king, that kind of thing. And silver you'd use for everyday transactions, or copper even, to buy milk or a cow or something of less value. And what happened in the 19th century was that improved printing techniques meant that you could have a document, a banknote that represented gold, which is a more efficient way of transferring value than using silver coins. And silver coins, I mean, notwithstanding the crime of 1873, in my view, was demonetized by the market because the market had figured out better ways to transact value than with fractional gold ways. It's pretty hard to pay the tiny amounts of gold, right? Unless you get a piece of paper that represents that. Mm-hmm. If you look at the 30s, right, when gold had effectively been demonetized by the government, by the market, in the deflation crash of the 30s, silver got slammed. I mean, it did horribly because it had no monetary demand, because the dollar was solid, gold was solid, and the economy was not doing well. In the 70s, it was the opposite, right? So I've heard from coin dealers in New York City that in the 70s, cab dealers, laundromat people who dealt in cash would show up every day and buy silver at the end of the day because they didn't want to hold dollars overnight. Inflation was that bad. So they wanted to convert it into something that was more liquid. And for those sorts of people, silver is more liquid. And silver returned, as I'm sure you know briefly, to the ancient ratio of 1 to 10. And then since then, it's been a straight hill down. So I don't think silver is going to come back and be money again. I don't think 1 to 10 is the natural level for the silver price. I do think that in an inflationary panic like the 70s, that the ratio could go far, far lower as people are looking for places to sort of store value. And as you want to put smaller amounts of value into precious metals, you can't afford a full gold coin, you're going to buy a bill of silver instead. Yeah. So for sure, silver's going to go up. I suspect it goes up faster than gold does. So I do have exposure to silver because I think it's going to go up more. But I'm less confident about that because silver only does well in an inflationary credit collapse, whereas gold does well in either an inflationary or a deflationary credit collapse. So I don't need to decide which way we're going to go. Now, I'm pretty confident we're going to have the inflationary way. and so silver's probably going to be better, but I don't know that for sure. And so that's why I manage, 80-20 rule, 80% gold, 20% silver, even though I think silver will outperform. And one more thing I might add is, and again, you can find someone with better stats than I have, but my understanding is that you buy a $2,000 laptop from Apple, it has, I forget, $1 of silver in it, some number like that, right? If that goes to $2, it really doesn't matter. And so in other words, the industrial users of silver are pretty price insensitive because they need the silver, but there's so little of it in their products that they really don't care. And then the flip side is that most silver is produced as a byproduct. There are very few primary silver mines in the world. So a copper mine, a zinc mine, has silver as a byproduct. In my opinion, China is going to blow up at some point. China is the locus of the biggest credit bubble has ever been. When it blows up, the commodity demand that China drives is going to go away. So all those zinc mines will go under. All those copper mines will go under, right? And so your silver production will go down. It won't matter if silver is at $100 or $200 an ounce because that doesn't support a zinc mine. And so what you're going to have is, even though silver price is going crazy, supply is actually going to go down as base metal mines close in the crash, and even a mild continuation of industrial demand will send the prices to the moon. So I can see a scenario, not just monetarily, but industrial, that sends silver up a lot. But again, my focus is on the monetary side, not the industrial side. But there is that factor people should be aware of. Anyway, that's for next time. Okay, appreciate it.
We appreciate it. Have a good day, sir.
Thank you, Dan.
All right. Thanks so much.